Recessions. Everyone is talking about them. Whether you follow the market and the global economy or not, you might be wondering what is going on. What is a recession? Can you save money during a recession? Is it possible to invest for the future during a recession? Well, I'm Kim, and in this Finance Spark video, we're going to answer these questions and try to get to the bottom of understanding what all this recession talk is about, and what you can do to invest and save during a recession. Are you ready? Let's go! Most nations have seen fairly consistent economic growth since the Industrial Revolution. But even so, there have been periodic economic downfalls ranging from 6 months to several years before markets revert to an upward growth track. These short-term reductions are referred to as a recession. If the market is a roller coaster, the recession is the downward fall that lasts a little too long for comfort. And the truth is, this part of the economy is uncontrollable. The causes of recessions have been a source of debate among economists for decades. In the United States, a recession is defined as 2 consecutive quarters of negative GDP growth. A GDP, or gross domestic product, is the entire amount of value generated in an economy. On a macroeconomic level, recessions occur when there is a negative disturbance in the supply-demand equilibrium. This basically means that there is a mismatch between the number of things people desire to buy, the number of products and services producers can supply, and the price of goods and services provided. In other words, there isn't enough stuff to go around. The link between economic supply and demand is represented by both inflation and interest rates. Inflation occurs when the prices of goods and services increase. High inflation that is not backed by increased demand or wage growth can wreak havoc on an economy. In other words, the purchasing power of money falls during inflation. Interest rates, on the other hand, represent the cost of borrowing money for individuals and businesses. The rate is expressed as an annual percentage of a loan. So, high interest rates raise production and consumer expenses, limiting economic activity. Shocks to society can also cause an economic downturn. This could be war, pandemics, or natural calamities. An earthquake might destroy the infrastructure for essential commodities like oil. As a result, the supply side is forced to raise prices for products that consume oil. It discourages demand and potentially precipitates a recession. Believe it or not, the US economy has had over a dozen recessions since World War II. The most recent one lasted from the end of 2007 to the middle of 2009. Within those years, the US GDP dropped by 4.3%, and the unemployment rate hit 10%. The prior recessions generate new information that may be used to better respond to future recessions. Governments and central banks can create money, raise expenses, and cut central bank interest rates. Smaller lenders can effectively cut their interest rates, lowering debt and increasing expenditures. Will you still be able to save money during a recession? A big yes! But you must take efforts to protect yourself and to take advantage of the opportunities that a recession provides. The first is to create an emergency fund. A recession can affect your daily finances, so set up enough money to cover 6 months of living expenses just in case. The peace of mind that comes with possessing a sizable emergency fund is priceless. Second, avoid selling your investments at a loss. Selling your stocks at a loss during a recession is the worst thing you can do. If the market drops, be calm and focus on the big picture. A time will come when the economy recovers, and so will your investments. So, if your portfolio has plummeted, don't sell, be patient. Of course, one thing you don't have to be patient for is the next Finance Spark video. I upload several videos a week, so you'll always be ready to spark your financial mindset. So go ahead and subscribe to the channel. And while you're down there, be sure to hit the like and bell icons to be notified when we release a new video. Okay, let's go on to the next one. The third, and probably the funnest part of saving during the recession, is stocking up on great companies. A recession is an excellent time to begin researching new investments. Keep an eye out for exceptional firms and add them to your watch list. Or you may have dreamt of a specific company's stocks, but held off because it was too expensive. When a country goes into recession, it is your golden opportunity to go bargain hunting. The fourth way to save during a recession is to seek out companies with a proven track record. Look for businesses that survived the 2008 recession and see how they performed. If they did well, it is a good indicator that they will be just as strong following the next recession. And finally, this is a great time to invest. I alluded to this before, but one of the smartest things to do during a recession is to invest. Boost your savings so that you can buy funds when they are on sale. When the market falls, there will be incredible offers on great firms. And then, when the market inevitably grows again, your investments will increase too. Be patient. You will be compensated. The bottom line is that when the market collapses, take the opportunity and jump in. Of course, this begs the question, which stocks or funds should you invest in? We know that investing is determined by your risk tolerance, time horizon, and personal goals. During a recession, it is about investing at your own risk. Here are several asset classes that you might consider during a recession. The first is that dividend equities generally outperform during recession. This is because regular dividend payments generally indicate that the company's cash flow is constant and solid. It is worth noting that dividend stocks are less volatile than non-dividend paying equities. Why? Well, it has to do with the fixed payments at regular intervals that the stock offers. Dividends should assist to reduce volatility in your investment portfolio. But if you are young, a complete dividend portfolio may be too conservative because it will not have much upside when it comes to certain market signals. According to Goldman Sachs, energy, consumer staples, healthcare, and utilities outperformed the index throughout the previous 5 recessions. Consumer staple companies do better during recessions because they generate items or services with relatively stable demand. This means that even if the price of a commodity or service changes, demand stays constant. Regardless of how the economy performs, there is nearly always demand. Walmart is an example of a consumer staple company. They offer products ranging from family apparel to housewares. People still need to buy clothing and household products regardless of the state of the economy. Only one sector in the S&P 500 has had positive returns for the 12 months before, during, and after a recession, and that is consumer staples. Recently, energy and utilities have been trading below their 10-year historical average valuation. While energy has performed well, as the energy crisis continues, it is possible that this sector will continue to outperform the historical average. If you want to get some exposure to the energy sector, you could invest in a sector-wide ETF rather than individual stocks. Another option is to practice dollar cost averaging. This means you invest the same dollar amount each month, but as the cost of an index or fund goes down, you still maintain that same amount of money. The difference is, your money buys more than it did before the drop. The key to this strategy is to keep investing regularly. We should all learn from past recessions, especially from 2008. 2008 was a financial disaster. When house values begin to fall, the financial system becomes inextricably linked to the housing sector. Lehman Brothers' bankruptcy in September of 2008 sparked a panic. If our economy falls into recession, do not panic. When you're in a state of fear, you can't think clearly. When investors like you feel fearful, you might make irrational judgments. A good example not to follow are fund managers who panic when the market falls and sell off all of their fund holdings. They do it out of fear of losing their jobs and maintain good statistics, but they just end up hurting their fund's long-term potential. At the end of the day, the scariest part of a recession is not knowing what to do. But hopefully, in this video, you learned a few things that can help you better understand a recession, how to save your money the right way, and how to invest for the future. But did I miss anything? Are there other aspects of a recession you think are worth noting? Leave your comments below and share your thoughts and ideas. That's it for this video. Thanks for watching and supporting the Finance Spark. Until next time, keep on sparking your financial mindset. Bye!